And on the IMF program, it was never part of our baseline that there would be a new program. There obviously will be discussions for a new funded program. But in terms of the financing and how much that would actually contribute by itself, it's relatively small given where Kenya is relative to its borrowing limits with the IMF. So you're talking about basically the ninth review of the previous program that wasn't completed. So 500-600 million. It's not a lot in terms of budgetary financing, but again, it goes back to the confidence effect and the impact that would have on investor sentiment and really on confidence over the reforms that would put debt on a firmly downward trend that would reduce the deficit in a credible manner.
If the value that the IMF or an IMF program brings to the table is essentially the signaling effect, doesn't that sort of lean the argument towards getting a standby credit arrangement rather than an actual funded program that's going to deliver, X amount of time over, or rather X amount of cash over X period of time? Because given the disagreements that we've seen between the Kenyan authorities and the IMF, especially with the last program, on specific policy reforms, and some of the policy, the resistance rather to policy changes we're seeing in Kenya, wouldn't a standby credit arrangement be, for lack of a better word, the optimal compromise?
It's one option, and I'm sure it's something that the government's discussing. I think when you look at the conditions for a standby arrangement, and you look at where Kenya is, when you look on the debt sustainability analysis the IMF conducts in terms of the risk of debt distress, I think you'd have to see some progress on the public debt side. I think on the external debt side, there's been more positive developments that may lead to an improvement in terms of the assessment of external debt distress. But I think there'll be a discussion over what fiscal reforms are needed to clearly put public sector debt on a firm improving trend, such that the IMF would feel comfortable with an SBA. But again, I mean the conditions, whether it's an SBA or an EFF, ECF, I think of course the SBA would be less onerous on the government. But as long as we see the requirements and the government taking steps and making progress towards reforms that increase our confidence in its ability to service its debt, increase investor confidence in the same, that's the key. Whether it comes with an IMF, with an SBA, or a different type of program is less important, at least as long as Kenya has access to Eurobond markets and has access to other sources of external financing, which to date they have.
Let's wrap up with yields on Kenya's Eurobonds, because there's been a dramatic improvement in yields. Somewhere around April, we're talking about double-digit numbers, 11%, 12%. That's come down in some cases to as low as 7% on some of our notes due in 2028. How should we read the market reaction in the last 4-6 months? Is the market effectively signaling here that there's a level of comfort that they would potentially have if Kenyan authorities said, look, we've put in the work, we've bulked up reserves. Now we'd like to move on to a combination of tax cuts and tax administration improvements in order to essentially grow the revenue base, and we need to lower the deficit?
Yeah, I think when you look at Eurobond yields, there are a number of factors at play. I mean, one is clearly markets have rewarded Kenya with lower yields since mid-2024, really, and there's been spikes in early April from announcement of U.S. tariffs, global sort of risk off in terms of sentiment. But overall, there's been an improvement in sentiment towards Kenya, and this has allowed them to come to the market twice to refinance the Eurobond that matured in 2024, but also to issue a bond earlier this year in February 2025 to buy back some of the upcoming maturities to push out the maturity wall a little bit. And so I think it's a combination of fewer Eurobond redemptions coming due in the immediate term, in the near term, the increase in reserves that you mentioned that give markets confidence that the government, even if they don't have access for a period of time to external markets, that they can rely on these reserves through issuing domestic debt and then converting to dollars, that they can service their debt. And we have started to see Kenya build a track record now over the past few years of accessing markets, of repaying maturities, whether it was with the support of the IMF and the World Bank in 2024, or now with the issuance in 2025. One thing we've always said is that Kenya will likely require market access on a consistent basis to continue to service its debt. And we look at the maturity profile, we look at the debt structure, the $3.5 billion that you mentioned per year coming due, a lot of it to commercial creditors. And there, the key has always been, and a key trigger for an upgrade in our view has been confidence that the fiscal adjustment will take place. Because without that, the concern is that large fiscal deficits are being financed by expensive domestic borrowing, and at some point, the interest bill keeps growing and limits the government's flexibility to adjust or to absorb a future shock. And with that, then we would see more credit challenges. So we still go back to the fiscal and the government needing to demonstrate an ability to credibly reduce the deficit to a level that's consistent with an improving debt trend and, more importantly, an improvement in its debt affordability.